You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, the program where we break down everything going on the other side of the fence. Maybe we'll talk some ags or some metals or some rates. You never know what's going to make it on the show. That's why you have to tune in every week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting network upon which so many of you are mainlining these days. I'm happy to see a lot of our newer listeners who are listening to, boot camp and OPR, some of our educational content, are finding their way to TWIFO. It's always fun when they're discovering these markets as well. So it's a fun progression to see. Welcome to all of you newer listeners out there as well. Remember, if you're one of our many on-demand listeners on all those platforms under the sun, all we ask is, if you like what you hear, keep rating and reviewing. There's a reason why we have so many new listeners discovering the show all the time. It's because we have such a great audience out there who's rating and reviewing. So if you like what you hear, keep rating and reviewing on your platform of choice. Of course, if you want to go above and beyond, you want to join us, we had a great pro Q&A just earlier this week with Mr. Scott Nations, the creator of VolQ, which we talk about on TWIFO, obviously, every week, as well as, of course, our Options Oddities program coming up tomorrow, as well as, of course, the giveaways and live for this show and every other show that we do throughout the week. You know where to go to learn more about that. theoptionsinsider.com/pro. And let's see who's joining us on the program today. Holding down the CME Group and FTSE Russell hot seat is a newcomer to the program and indeed to the network. He gets the award for the longest business card we've had on the network in a while. He is Rich Excell, the clinical assistant professor of finance, the co-director of the Investment Management Academy, and the director of the Margolis Market Information Lab at the University of Illinois. Rich, welcome to the program, and I'm not sure you can fit into the seat with that business card, sir. It is very extensive.
It definitely has the pockets bulging. It's good to be here, Mark.
Well, Rich, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background in the options and derivative space, as well as what you do over there at the Margolis Market Information Lab.
Sure. So I got my start back in the 80s and early 90s on the Merck floor. I started in the business trading foreign exchange derivatives, foreign exchange options, and then spent the better part of the 90s, if you will, trading in foreign exchange options at an investment bank. A lot of it moved upstairs. I moved overseas, moved to Asia, and stayed in that world. And then in the early 2000s, I pivoted my career into the world of hedge funds and mostly focused on equity long short. And so then I started on the other side, on the client side of the business. I originally was a market maker, but I started on the client side using a lot of options to implement my ideas on the equity long short space and using index options and overlays, et cetera. So I've kind of come at it from the world of initially foreign exchange and precious metals, where I started. Then I spent a lot of time in using index equities and rates options from a hedging and tactical purposes. And so from a few different angles, I come at the world of derivatives. And now at U of I, I'm lucky to be teaching classes on investment management, portfolio management, derivatives, et cetera. And in the market information lab, the Margolis Market Information Lab, we have all of the trading software that professionals would use, and we are using all of that to teach our students how to become, hopefully, a little bit more well-educated on how to look at and analyze the markets so that when they're going into the working world, none of this stuff is new to them.
I have seen that lab. It is very impressive. I wish we had it when I was an undergrad. I had to kind of sneak my way into a grad school derivatives course to really learn about options for the first time as an undergrad there, Rich. So sounds like the students over there at University of Illinois are ahead of the game when it comes to access to derivatives information, sir.
They are, but I tell you what, there's a ton of demand. The students are really looking at the options market, the derivatives market, especially because there's so many tools available to investors of all types these days. And I think what I've just really surprised at is the insatiable demand from all the students to want to learn about it and want to use options in the way they even in their personal portfolios. And so I think it's an exciting thing to see for the options market.
This has to be the best time in history to teach about options, because you're right. We've never seen such an explosion of demand, particularly from your audience, the young student age kids who are discovering about options on TikTok and Reddit. They realize they can learn about this at school. I mean, options, dare I say it, Rich, options have never been cooler, I don't think.
I think you're right. I would hate to say that they weren't cool when I went into them, but I would say that they've probably never been more in vogue, for sure.
They've always been cool, you're right, but they're more widely accepted to be cool now. Let's just put it that way.
Yeah, I think that's good to say.
All right, we could talk about options education for hours, but it is time to get rolling. It is time for the movers and shakers.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report. This is, of course, the portion of the show where we break down everything moving to the light side, a.k.a. the upside, and to the dark side over there at CME this week. If you want to see this report for yourselves, if you follow CME on Twitter, if you follow us on Twitter, we tweet it out right before showtime. That's pretty much the only way you can get it, unless you are a pro user over there at Bantix, BANTIX.com. We're going to talk a lot about Quick Strike. We always do on the show. We're probably going to talk about it even more today. So if you are even remotely intrigued by these markets and you haven't kicked the tires and lit the fires over there at Quick Strike, what are you doing? Bantix.com, BANTIX.com, the place to go to begin your journey with that free trial. So, Mr. Rich here, we have our choice. Should we begin our journey this week to the light side or to the dark side, sir?
Well, I think maybe we should start on the dark side and work our way to end on a positive note. What do you think?
All right, I think we can do that there. So, yes, it's looking actually, despite the sell-off that has been catching a lot of headlines in the broad equities, this week actually is biased towards the green. I would say probably 60-40 green over red this week, even though the most extreme movers are still on the red side. But to the dark side we go. Number 5 on the dark side. This is a frequent offender of late, even though, as we know, probably 3 contracts have gone up this week as we kick off the show. This is Oats once again popping up on our movers and shakers. This time to the dark side. Number 5 off about 3.75%. It was number 1 in the other direction last week, moving almost the exact same direction. It was 3.7% to the upside last week, and that was good enough for number 1 last week. So a bit of a weird week last week. Number 4, back to energy. It's heating oil off 6% exactly. Very rare that we see that. Number 3, soybean oil off 9.58%. Number 2 is the old euro dollars, 24.7%. We talked about it before. Kind of a bit of a moving average when you're looking at these euro dollars numbers. Kind of hard to get one number that encapsulates the movement across all the different term structures out there. To give you a frame of reference, last week it was number 2 in the other direction, up 3.3%. And number 1 to the dark side this week with a very firm bullet. I've said it pretty much every week. If you guess one of 3 names, listeners, lumber, nat gas, or Bitcoin, you have a chance of being right in one direction just about every week. This week, you would be right to the dark side with lumber off 29.23%. Just a lumber apocalypse. So all of you out there who maybe been waiting for lumber to come in to build a house, or as our old co-host on the show used to do, he had his fence watch. He wanted to wait to build the fence until lumber prices came in. This might be a decent week to do it. Lumber off nearly 30%. My goodness. Now, to the light side we go. I mentioned Bitcoin. It doesn't even make it into our top 5 this week. It's only number 7, and it's up nearly 4%. That shows you how much green we have on the screen this week. Number 5 is actually silver, up 5.36%. It was number 5 in the other direction last week, off nearly 7%, 6.9%. Number 4, lean hogs. I have a feeling we might be coming back to that one a little bit later today. Lean hogs up 5.62%. Number 3, soybean meal up 6.01%. Numero 2 is nat gas, one of our other frequent offenders out there, up 7.64%. It was number 2 in the other direction last week, off nearly 13%. So quite a wild couple of weeks. But then again, what week hasn't been wild for nat gas over the last few months, ever since the invasion in February, listeners? And of course, number 1, yet again, we might have to start restructuring our top 3 to perhaps a 4 of frequent offenders, because palladium often in there as well these days. This week up 16.36% to take the number 1 spot. Again, before you ask, palladium not really a big options stalwart out there. All right, a lot to unpack, a lot of complexes to get to, Rich. But I think this week, because it is still top of mind, it is still one of our frequent movers and offenders, I think we have to start there. It is time to get into a little bit of the old energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the energy segment. You guys know where to go to find these reports for yourselves. CMEgroup.com/TWIFO, TWIFO. That'll get you access to the free version of our TWIFO reports. Then go into that drop down on the asset class, scroll down about 3 notches to energy. Then you're going to go over to the product family of natural gas, and we're going to hang out there to kick things off. Rich, I know you have a lot of products that you're watching over there these days. We're going to get into a lot of those in a few minutes, but obviously for a lot of people, including on our movers and shakers yet again this week, energy, in particular nat gas, is very firmly in focus. Is this a product category you've been watching of late, Rich?
Yeah, I think everyone's been watching, including Jerome Powell. It's kind of hard not to watch it, right? It hits us across a lot of different things. You mentioned nat gas, oil, gasoline, the entire complex for sure.
Well, let's get into it then. Again, nat gas, as you said, a frequent offender out here. Let's get on out to the reports. By the way, how much paper is going up on a pretty active week on nat gas? You know, a decent week. We usually see about 400,000 contracts on the tape. This week, not quite there, listeners, about 365,000. So an active week, but not quite blowing the doors off. And of that, 45, almost 46%. This just kind of goes to show you how much nat gas has evolved a bit. Also, where the product is right now from an expiration perspective, because 46% of that nearly 365,000 contracts is going away in 6 days, listeners. So a lot of near-dated high gamma trading going on in nat gas right now. Instead, I think we're going to go a little bit farther out to find a contract that has a little bit more meat on the bones. So let's go out to the July contract. That did 14% of the paper, listeners. That has 39 days to go, just because, you know, measuring gamma and skew going out a week, or not even a week, 8 days, 6 days is a kind of bit of a fool's errand. But a month or so. That gives us a little bit more meat on the bone. By the way, you might be asking, where is nat gas right now? Right around almost 838, very close to it out there. And if you go out to the July contract, that future is actually almost 8.5, about 847 out there. So not quite threatening that 10 handle, but looking pretty robust, well north of the 7 handle right now. In terms of vol, what is the vol out here? We know nat gas vol can get pretty frothy. It can threaten the triple digits very easily. Right now, not quite there, but pretty darn close. Almost a 90, about an 89.90, up about 1.6 points on the week. That front contract that's going away in less than a week, that's a 94. So that's even looking more frothy. Again, that's not a lot of vol on a weekly contract, but c'est la vie, that's where we're looking there. In terms of skew, last week the puts 4.4% cheap. This week, nearly 7%. So the puts coming in pretty aggressively. The calls last week were where the action was, and that remains the case this week. The calls last week, 8.2% bid. This week, 8% bid. So, yes, a lot of interest still in the calls. Can you blame them? There's still a lot of question marks about what's been going on in Eastern Europe. Let's go out to the options, see what the hot contracts were for this week. Like I said, 46% of the paper is going up in June. It was the June 10 calls. This 10 strike has been a frequent refrain for us here on the show for quite some time, and it remains the case this week. The 10 calls going out in 6 days, trading 32,500 contracts, including, get this, listeners, 25,000 today. My goodness. Looks like there might be, and there's 20,600 of the 10 calls, the 10.10 calls, and then the 9 calls doing 10,870. So it almost looks like a bit of a funky fly, but the 10, 9, 10, 10, 10, that would be very strange strike selection. Either way, there's a lot of paper going up today, listeners. Of that 32,500, 25,000 of the 10 calls that going up today, the rest scattered throughout the week. A lot of back and forth, opening and closing throughout the week, but obviously we don't know about today's paper, but there's clearly a lot of interest in the 10s and the 10/10s today in June. Again, these are going out in 6 days, listeners. So this is very near-term paper. I have to imagine just the size of the paper going up. That has to be opening. The OI is only 9,000. So 25,000 contracts going up today. There's a lot of opening paper on the 10 calls going out in 6 days. That is extremely interesting, listeners. So yes, number one with the bullet, the 10 calls, followed by the 10 calls right behind it. And then the 9 calls. So a nice hefty call strip in June there. My goodness, doing, 70-odd thousand contracts just in those 3 contracts. Wow, a lot of very near-dated call paper. I suppose we shouldn't be surprised given what we've seen out here, but still, that's interesting. Rich, you mentioned you kind of watched this market. I'm curious, any of those students that are coming to you guys down there at U of I, have they started to get intrigued by energy and nat gas, given what they're hearing in the headlines? Or are they still pretty much all meme stocks all the time? And what are your thoughts on this explosion of very near-dated upside call paper here in nat gas this week, sir?
Yeah, there's a lot going on. I would say the students have definitely gotten more interested, and I think it was really, it was the events in Europe in February and March that really kind of started to get everyone to focus on the importance of the energy markets and the importance of the agriculture markets too, and how that's going to be impacting everyone. So I think I've definitely seen an increased interest in this. We talk about nat gas, we talk about trying to, what might come through to try to resolve some of the issues that are going on in Europe in terms of the cost of nat gas there. Not sure anything's going to happen in the near term, but it sure seems like somebody thinks something is going to happen in a very short period of time here on the upside. That might be a sense of some sort of demand that's coming through for nat gas outside the ordinary seasonal types of moves that we would see, right?
Yeah, someone is betting on a whole heck of a lot of something happening in the next 6 days here in nat gas, Rich. So this is one to pay attention to. We always pay attention to nat gas anyway, but listeners, but this is an explosion of paper just today out here in nat gas on some very funky strikes. So even if you don't pay attention to nat gas, maybe worth paying attention to it over the course of this next week. See what went up out here today, if this person is actually right, and then we shall see. Meanwhile, though, it is time to keep on rolling with the show. Rich, a little birdie may have told me that you've been doing a little bit of research into the ag, so I think we'll hang our hats there next.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, everybody. Welcome to the ag section. You guys know where to go. It's easy to find. It's an alpha order list. So just go right to the top of the asset class list, and you will see the full selection of ags at our disposal. Mr. Rich, why don't you break down for our listeners what's been catching your eye out here in the ag markets? You had a few trades that you've been talking about over there at CME. What's the first trade that you think is going to interest our audience?
Well, the first trade that was interesting to me was in the hogs. It's been a place where for the better part of this year, we've seen, obviously we've seen prices moving higher, but we've also seen options demand moving higher. A six-fold increase in options in the December contract. And you've seen, quite a bit, initially we saw a lot of demand for the calls. Now we're seeing a lot more demand on the put side of it. So to me, I was looking at the idea that we've got, the front month contract, or the generic first contract is up near 10-year highs. We've seen a big uptick in the options demand in the December contracts. And we're going into a period that if we look back over the last 15 years, we are going into a period where seasonally, here into the July, August, September period, we see oftentimes a lot of downside price action. Now, of course, looking at seasonal sorts of trends doesn't always give you an indication of exactly what's going to happen, because not every year is the same. But I think when we kind of combine all the fact that we're at very, very high levels in the futures relative to their history, we're at very high level in options demand, and a lot of that demand is coming through on the put side. And we're going into a period where seasonally we see some lower prices. To me, it was time to maybe look at, can we find a way, in an interesting way, to take advantage of this and set up for a potential disappointment for what people might be looking for.
Rich, I have to admit, when they told me you wanted to discuss calendar flies on the lean hogs, that wasn't my first guess. I think you're definitely the first guest to come to us with that suggestion, Rich. So you mentioned kind of some of the setups. Lean hogs, you're right. They have been more and more of a fascinating product. In fact, we have talked about them not too long ago on the show. When we first started doing this show, and in particular in its previous incarnation of the long and short of futures options, lean hogs was kind of an afterthought when it came to options market. It would maybe do a few thousand contracts here or there, but it really wasn't that robust of a marketplace. Fast forward to today, that has changed quite a bit. I could see why maybe you're starting to look at some interesting setups out there, because right now, as we speak on the show here, 40,000 contracts have gone up in lean hogs. That is nothing to sneeze at. That's probably beaten silver, I'm sure, if you pulled it up right now. So lean hogs starting to become more of a player from an options perspective. What does that mean to you, listeners? Well, as Rich was just saying, now some of these strategies that you might like to utilize in other deeper, more liquid markets, like some of the maybe larger ags like corn or the equities or places like that, Eurodollars, you can maybe start looking to apply those here in lean hogs. By the way, lean hogs right now, listeners, 105.6 on that front June contract. It has about 26 days to go. If you're wondering, what is the vol out here? It's not quite as robust as an equity, so it's not even in the 30s, but it's not also, you're not talking the 30-year either. It's not a 4. So it's got a decent bit of vol. It's almost 24, about 23.84 in that front contract, off about 2 3/4 points. And let's see, looking at the skew out here, last week, the puts were 4.5% bid. This week, even more juicy, 5.8% rich to the at the money. Last week, the calls were effectively unched. There was no interest in them. This week, they are down about 2.1% to the at the money. So they have come in. So puts are bid, calls are coming in. By the way, the hogs are up about almost 5% just since Monday's session. So quite the active week out here for the hogs. And what is the most active contract out here this week? With 52% of the paper going up in the June expiration cycle, it looks like the 92 even puts. Interesting. We're at almost a 106, and it's the 92 even puts out here. But Rich, I'm kind of burying the lead here. You mentioned looking at some interesting ways to get exposure out here in the hogs. Why don't you break down what was your approach, what was your trade, and why did you decide to go that route?
Sure. I think one of the other things I wanted to look at is the volatility term structure. So if you look at the term structure volatility, you see that the July and August contracts do trade well above the contracts around it. So you mentioned that the June contracts are somewhere in the mid 20s type of range, and if you kind of go back out to September, October, you're in the similar sort of mid to low 20s implied volatility. But that July and August contract is in the low 30s, And so that's, again, probably a little bit of the market knowing that this can be a seasonally weak time for the prices, and looking to maybe put on some hedges there. You talked about the demand and that we've seen for some of the downside. And so what I was trying to think about is how can we take advantage of the fact that we've got this kind of bubble in the implied volatility term structure to set up a bit of a trade that might take advantage and might be there for you to help on the downside, but without having to buy the options that everyone else is buying, right? Instead of just going out and buying puts where there's demand for the puts and you'd be paying the highest part of the volatility term structure, is there a way we could take advantage and sell some of those options? And so what I look to try to do is set up an idea where one would be long the calls in the June contract, short calls in the August contract, or sorry, September contract, and then long some calls in the December contract. So a butterfly, but a calendar butterfly, so across dates. Now, there's a lot of moving parts in here, Mark. There's, you've got the volatility, different volatility levels. You've got the different futures prices, and so there's a lot of basis risk, a lot of things that could go wrong. So I'm not saying that this is necessarily for everyone, but if you look at the resulting position, you really end up with what looks like for the next 35 days or so. It looks a lot like a back spread or a long volatility position, and you'll obviously have to work on re-engineering the position a little bit as those June calls would go away. But there's some things you could do with that. But I was looking to try to take advantage of what the market gives you and set up a position that might be consistent with the kind of fundamental view that we might see some seasonal slowdown in prices.
Yeah, you're right. And traditionally in the past, if someone had come to me and said, I'm going to do a calendar fly, it looks like, if I'm doing this correctly as well, it looks like you did it on a bit of a ratio, so a bit of a funky ratio too as well, Rich?
A little bit, yeah. I mean, again, just I'm when I'm setting that up, I'm really trying to set up and look at the Greeks and trying to make sure that the Greeks are where I'd be comfortable with, or where I think people who would set that up would be comfortable with running that position.
Yes, in the past, if someone had come on and mentioned this, I would have been a little leery because it's lean hogs. Whatever you put on, you're going to be wearing it for a while. But as I just mentioned, there's 40,000 contracts going up this week. So that concern has been mitigated. You can get in and get out of lean hogs now if you're a little bit deft with the trigger fingers. This is a fascinating one, listeners. I encourage you to check out Rich's article. He has the full graph of the term structure here, as well as looking at it. By the way, I noticed you also use the CVOL in your analysis. These are, of course, the indices that Derek Salmon has come on many times from CME listeners to talk about. Right now, they're still close to close, so kind of once a day updates of vol, but they also have some interesting skew metrics. It seems like you've been utilizing these in your analysis as well, Rich. What are your thoughts of the CVOL indicators?
I mean, I think the CVOL indicators across all the products are just really just terrific products to use, and especially ones where we could use the CVOL and look at upside skew and downside skew. I think for a lot of us, when we start to look at a market, maybe it's even a market we're not that familiar with, the first thing we want to do is kind of get a sense of where is implied volatility relative to its historical period, some historical measure, whether that's last 1 month, 6 months, year to date, 3 years, 5 years, whatever it is, and just have a sense like, am I paying a high price or am I paying a low price? And then look at that skew, and you can look at upside CVOL, downside CVOL, and say, what's the relative pricing look like relative to history? And bring up a time series of those things. I think the more we can get that information, especially for those who aren't in the weeds and looking at things on a day-to-day basis, they can get up to speed pretty quickly about where the current market pricing is relative to where it's been before. So I think it's a really good sense of, at the very least, some background information for people as they're trying to think about, how do I want to approach this idea? Do I want to approach it from a net long options idea? Do I want to approach it from a net short options idea? Where should I favor upside? Where should I favor downside? So I think the CVOL products, not just in the ags, but across all the products, really do a good job of giving a context to how you might want to think about setting up an idea.
This is an interesting structure. Like I mentioned, listeners, check it out for yourselves if you have any questions, but I'll just break it down for you really quickly. It was the June 103 call, picking up essentially 3 of these. And then against it, he has the August 90, 108, 1x2, so long 5, short 10. So that's kind of where the calendar aspects comes in, is the June-August expiration. But it's a kind of a fascinating structure. Again, interesting setup, interesting product that we don't often get a chance to talk about here. Looks like we have some questions coming in from our live chat about calendar flies. Maybe we'll get to those in a little bit on the futures options feedback, Rich. But yeah, I'd expected that. Once we start talking about calendar flies in the hogs, I expect some questions to come in. But let's keep on rolling. I mentioned the ags and the hogs. Yet another interesting fly, this time a more traditional fly, at least in terms of the same expiration month. But in another very liquid ag market, Rich, what was your next ag fly idea?
Well, corn has obviously been in the news. I mean, I think all the crops have been in the news this year because of what's going on in a major area of production. And so corn is something that we revisited. We looked at that. Earlier, I think in March of this year. And again, we're seeing a lot of demand in corn options. And so the question then is, how do we want to look at potentially playing the upside in corn, even though, of course, we've already been moving higher. But there's other potential sources of demand that weren't there and aren't normally there this time of year. One of the things I referenced in the report was the fact that the administration in Washington has temporarily allowed E15 gasoline in the summer, which we typically don't do from June to September, which is an incremental source of demand for corn. And so there's maybe some incremental drivers that could have us see a little bit more upside. And so, and the other thing I highlighted on in the report this week was the correlation between corn prices and energy prices, which have really the correlations have moved up considerably, not just this year, but since the ethanol policy was put into place, I think back in 2006. But you can certainly see over the course of the last 2 years, there's a very tight correlation between the two of them. And so in many ways, and highlighted again by this decision to allow the E15 this summer, corn prices and energy prices are going to be tied pretty closely together. So it's not just the drivers of the traditional drivers of corn over the summer. You're going to have to be watching the traditional drivers of oil price as well. And so the idea was how can we look at all of them, take these factors into account, and set up an interesting idea in the corn options market. And so we use what I call, or people I used to work with and we would call them a split strike fly. So normally when you think of a butterfly or a call butterfly, obviously the strikes are set symmetrically. And in my experience, and maybe others have been more successful, but calling the direction and calling the exact place where something's going to stop is proven to always be a little bit more difficult for me. So I've always tried to look at a split strike fly where it's a bit of an asymmetry between the strikes, because that way, if we move in the direction that I think we could move, but move too far, I'm still going to be able to lock in some gains if we can blow through the higher strikes. And so that's what I really look to set up in the call butterfly using a split strike fly, where I would buy the 760 calls, I would sell 2 of the 800 calls, and then I would buy 1 of the 820 calls. Again, so normally that would have been an 840 call to keep it symmetrical. But this way, if we move above and through the upper strike, I still have some parity that's going to be locked in. And so I'm getting a little bit more of a directional call and not just a volatility call on this corn call butterfly.
And obviously, if you're trimming the upside a little bit there, you're going to pay a little bit more for this fly. But it sounds like you're okay with that, Rich, for the potential of this trade.
I'm okay with that because when I look at again the cost that I'm paying versus the max possible loss versus the max possible profit, that's a 4-to-1 spread. And so of course you're never necessarily always going to achieve the max profit, but I think there's enough edge on the way in that it allows me to pay a little bit more because of the distance between the strikes. But I think the other thing that I would say is that when we look at this in the first, I looked out to do this out into December, and so if you look to do this, after a month or so, you see using the quick strike tools, you can see that the expected return on this butterfly is still relatively smooth, even a month into this trade. And so you're going to have a chance to look at this and watch and see what happens. before the theta starts to kick in and the max loss potential starts to increase. And so you could certainly adjust the strikes or even look to close out the idea if it's not working over the course of the next month. So you've got enough time when you do it to really be able to manage your strikes or manage the position. And ultimately, if you get that early move, the max profit versus loss, I think is the reward to risk, if you will, is pretty desirable.
Yeah, I'm definitely with you on the skip strike flies. I can't remember the last time I did a straight symmetrical. I'm always playing with the strikes. That seems to be, you're right, the best way to do the butterflies. Interesting, though, that you went all the way out to December. And I know for a lot of people, when you go that far out with flies, it sometimes is hard because, as you mentioned, you need to get that theta to kick in a little bit to let that fly widen out to really get your maximum benefit out of it. So if you have this fly on in December and you get a nice pop in, let's say, July, you might not see a lot of that reflected in this fly yet. You're not concerned about that?
No, I'm not, because if we're looking at some of the movement, I think we're going to have a lot more clarity on the real direction of the price of corn well before we have to worry about that. And so I think you can get into this idea at a very, very low opportunity cost and really kind of sets itself up to something that I think could be more meaningful. If we get a move higher in futures over the course of the summer, I think this thing, all of a sudden you come out at the end of the summer and you're like, I really kind of backed into a really nice idea here. If we get a move lower and prices on a lot of product move lower, then like I said, you could manage your way out of the position for not too much of a loss, and it was just something that was kind of a potential, but it wasn't something where instant gratification. I think you talked earlier in the show today about how much of the options trading and options demand has moved really inside of the front month, if not in the front week or so. I think a lot of times people are looking to the options market for these instant gratification type ideas. Sometimes I'd like to layer in also some ideas that could grow and maybe add some value over time that you just put in the portfolio and kind of forget about it until the alert goes off that says you should take a look at your strikes in a month or so. So I think you want to kind of build a little bit of a layering of types of ideas in your portfolio.
Well, that's definitely true. The farther out you go, you're going to get a nice deal on that fly. It's not going to cost you as much. So certainly from an opportunity cost perspective, if this one intrigues you, listeners, it's not going to be overwhelming. If you want to know those strikes again, this was December 760, 800, 820 fly in corn. We'll put out a link to that so you guys can check it out as well. So let's look really quickly here at corn. By the way, I pulled it up. We were talking about lean hogs before. If you're wondering, why are you talking about lean hogs on the show? They don't do a lot of paper. Well, I pulled it up. Silver, only 17,000 contracts on the tape right now. We've talked about silver many times on the show in the past. So lean hogs, more than 2x silver now. So it is very much becoming a relevant options player out there. But we know corn does some paper right now, looking pretty robust again. Almost 520,000 contracts on the tape right now for corn. Corn still the big dog in the ags complex. It's the Eurodollars of the ags complex, quite frankly. And of that, unlike an equity, which is refreshing about the ags, it's not all going away tomorrow. About 30% of that paper went up in the July expiration, so that has about 36 days to go. If you're wondering what is corn vol right now, it's flirting with the 30, 29.86. So corn vol and equity vol looking pretty similar. VIX cash hanging around a 30 these days as well. In terms of skew, we had the puts last week, 1.5% rich. This week, 4.9% cheap. So the puts have swung markedly to the dark side. The calls last week, 22.5% bid. My goodness, this week, 2.4. So the calls have come crashing back to earth, and the puts have gotten annihilated as well. So both wings have gotten crushed, which is interesting because the vol is up, but both wings have gotten annihilated. The calls much more so. Wow. That is interesting. That's why I love the ags. The skew swings can sometimes be wild and crazy out there. In terms of the most active contract this week, it looks like it's the 850s. By the way, coming into showtime, that front future at a 782.25 here for corn. So the 850s in July taking the top spot this week. So obviously these are pretty substantially out of the money calls, doing about 14,000 contracts. Actually pretty light for corn, but again, it's kind of like Eurodollars in the sense that a lot of the paper is spread out over multiple months and strikes as well. It's not just 1 month and strike that does all the paper. So 14,200 for number one. The big day was yesterday, 6,000, 4,000 on Monday, 2,000 on Tuesday, 2,000 today. It looks like mostly closing throughout the week. So that could probably account for why this call wing came crashing in. People were dumping their 850s. Looks like they were dumping their 900s as well. Those did about 12,000 contracts this week. Pretty much mostly closing. Looks like the only openings we have really were a little bit on the 800 strike. But yeah, it looks like a lot of closing paper on the 900s and 8.5s. And they came for this call wing. Wow. Rich, what are your thoughts on this? Just annihilation of the call skew here in July corn this week, sir.
Well, I mean, it's hard to say what's driving it, of course, but I think that I got the sense that in a lot of products across not just the entire futures complex, but across a lot of complexes, there was a fair bit of reduction of risk that was going on in the last week or so. And so perhaps this was just some reduction of risk that was maybe initially a hedge and an overall position was closed, or maybe it was the actual position itself. So my sense is there's been a fair bit of risk reduction that's been going on across all products.
And people had some upside flyers on in some of these ags and other products, nat gas maybe coming this week and mitigating some of that, because a lot of people taking off upside calls, at least in corn this week. But we have to keep on rolling. It's that time, listeners. Time to talk about some equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Welcome to the equities. You guys know where to go to find this by now. Go back into that report, get out of the ags, and scroll down to equity indices. We're going to kick things off in the Russell 2000. Before we do that, let me set the table. From a vol perspective, it's hard to talk equities without talking the flip side, which is vol. And coming into showtime, they're all down from our last show. It shows how frothy things were this time last week, even though they are still comparatively elevated compared to their historical norms. For example, RVX, the VIX of the Russell 2000, was almost at a 36 when we kicked off the show, 35.78. It took a while. Remember, we kept asking for a long time on the show, is it going to break 30? Is it going to break 30? Well, it has done that and has maintained 30. In fact, it was threatening 40 on our last show. So a small cap vol, we're looking frothy. VIX cash was at about a 30.5 when we kicked off the show. That's still down 3.65 points from last week's show, but also, again, north of 30. So obviously still a very elevated VVIX. So the vol at about a little bit north of 108. That's down a whopping 18 points from this time last week. Vol Q, so the at the money vol of the NASDAQ 100. Remember, we just had the creator of Vol Q, Mr. Scott Nations, on our pro Q&A earlier this week. So check that out, theoptionsinsider.com/pro if you are intrigued. The Vol Q at about a 34.41. It's down 6.5 points from this time last week. So vol crashing in across the board, even though, again, it is still elevated. That puts that VIX to RVX, so that large cap to small cap vol spread a little bit north of 5, about 5.3 points. That's still come in. That's still tighter. That's about 0.75 of a point tighter than it was last show. That's still pretty wide, over 5 points between large caps and small caps. That's a pretty wide vol chasm there. And VIX to vol Q, so the S&P to NASDAQ vol spread, it's about exactly a 4 when we kicked off the show. It's actually almost 3 points tighter, about 2.8 points tighter than it was last week. So both those spreads coming in. VIX to vol Q looking closer to normal, but that VIX to RVX one looking surprisingly wide. Rich, when you're not looking at funky flies in the ags, anything catching your eye out there in the world of equities these days?
Well, I think when you're talking about, if we just start with it, everything gets kind of priced to me off of the SPX or the VIX. You're looking at about 2% a day kind of break evens. And I think, if you look at the realized volatility, what you're seeing is that the traders are able to be covering their time decay right now, and therefore are going to maintain a bid to the S&P options and the VIX options, because if you're covering your time decay, you might, and you're in an uncertain world, you might as well hold on to those options. They're not bidding them up because they're probably seeing some unwind of hedges or some overriding going on that kind of gives them a little bit of that inventory from their customer base. But I think that when I see the traders are able to kind of cover their time decay, it tells me that we're going to probably hold in it somewhere around these levels, even though they seem high in absolute terms. Ultimately, what people worry about or what traders should be worried about is whether or not price is what you pay, value is what you get. And if you're getting value, you're going to keep paying that price.
Let's see how much people are trading and paying out here. Let's go out to the small caps first. About 20,000 contracts on the tape. So not the most rock'em sock'em robots of weeks. Again, Lean hogs taking the crown there as well. Lean hogs, much more of an options player than anyone expected a few years ago. But of that paper, it is an equity. So, of course, the small caps going to do most of their paper. 37% of that paper going away in the contract that expires tomorrow. So we're going to roll a little bit farther out to, let's see. If we go to the June contract, actually, no, let's go a little bit farther out. 30% of the paper went up in the June contract here. That has about 28 days to go. So, yeah, let's hang out there instead. The vol, by the way, we just said the RVX, that's that kind of rolling 30-day VIX methodology. That's nearly a 36. If we go out to the actual June contract that has almost 30 days to go, that vol is about a 32.4. So pretty close to the VIX number. Remember, that's not just at the money vol. That VIX has, skew and everything else. So it's going to be a little bit different than the straight at the money measure. In terms of, by the way, small cap 1790 to kick off the show. They're actually up a whopping 1 point on the week. So that's kind of reflecting of the back and forth we've seen out there and across most of the major equity indices this week. Right now, as we speak, small caps up a whopping 1 point on the week. In terms of skew, we're talking about 11.6% rich for the puts last week. They have gotten a little bit more bid up to 12.4% bid this week. The calls last week, nobody wanted them 10.3% cheap. This week, people want them even less, nearly 12% cheap this week. And in terms of the most active contract out here, looks like everyone wants to know about the small delta calls. Doesn't seem like small delta calls. Actually, it looks like it was exactly a tie between the 1,800 calls going out tomorrow. So these are at the money calls right now, listeners. And then we have the 16.5 puts in the June expiration cycle also going up. Those pretty much all went up on Wednesday, the 16.5 puts. Looks like a 16.5, 17.5 put spread going up for about 1,000 contracts or so. So pretty active stuff out here in the out of the money puts in June. Again, 16.5, 17.5. That isn't that far out of the money. We've seen a lot farther out of the money put spreads here and put trades in general in the small caps. So intriguing stuff. I want to keep talking about equities, but I see we have some questions coming in. So let's try to squeeze some of you folks in, a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options. Facebook.com/The Options Insider, StockTwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. You guys know how to get at us all sorts of different ways, social media, email. We have a lot of those, but of course, all you folks in the pro, and you have questions, you guys get bumped to the top of the list. Let's see how many we could squeeze in here. Let's go to Option God first. Remember, Rich, I said earlier I had a feeling that Calendar Fly was going to prompt some questions, and it has. Option God says, I'm not really familiar with calendar butterflies. What are the advantages of this trade versus traditional butterflies in the same expiration? So as I recall, with your lean hogs fly, Rich, you were in 1 month for the first leg, then you had kind of a 1x2 vertical in a second month with that. What are your thoughts on that structure? Why did you go about that? And for our listener here, what are some of the advantages of a calendar fly, easy for me to say, versus a traditional fly?
Well, I think the advantage is you're really trying to take advantage of the hump in the term structure of implied volatility. I think that's to me, when I look at it, that's the biggest thing you want to do. And so I think ultimately, when we think of the term structure of volatility, what you really want to try to back out or bootstrap is what's the marginal volatility between expirations, right? So when we have a June volatility that's a couple points below the July and August volatility, what is that really implying for what the forward volatility is going to be once the June rolls off? And I think what that's telling you is that there's really high expectations for volatility going forward. And so you really want to put the meat of the trade in that area, but you want to be cognizant of the fact that there's going to be some risk. And so you want to use those shorter terms, or in this case, I went a little bit further too, to try to take it, to try to use that to hedge out some of the near-term risk and hopefully let some of the natural gravity of the options market kind of pull it down and do some of the work for you before you really want to spend the extra premium to cover that final leg in the same time period.
Yeah, the key is definitely the term structure there, option guy. A lot of you are used to doing your flies in equities, where term structure is obviously an important part, but you don't see as crazy of the evolution outside of maybe earnings as you do in some of the commodities, where the term structure can have all sorts of interesting shapes to it. And sometimes a call fly or a calendar spread really can be a good way to take advantage of that. So maybe a little bit more interesting use case for some of these calendar flies in the commodities and the futures options versus your traditional equities. But good question out here. Let's go to another one. This comes from Frank 1209. He says, Rich is an FX guy. What does he think about the euro and the dollar going to parity for the first time in 20 years? Yeah, that's been in the headlines a lot lately. We didn't have a chance to get to it. For obvious reasons, FX is not really a big mover and shaker from an options perspective, and from a vol perspective, not really a big player there either. So it doesn't really make it on the show that often. But Rich, you mentioned earlier on that you have a background trading FX for a while. We're kind of approaching some historic territory where the dollar and the euro may be looking at parity for the first time in quite a while. Our listener, Frank, wants to know, what are your thoughts on that, sir?
Well, I think, my experience from the world of FX is that money goes to where it's treated best. And so capital looks to rotate or move to the places where it thinks it has the highest expected returns. And so for the fact that we're seeing the dollar do better than some of the other reserve currencies, such as the euro or even the yen, it's because the global investors are thinking that they're going to get a higher potential return on investment in whatever their investment is in that domicile. Now, we have to understand in foreign exchange, there's a couple other dynamics. You have the dollar, the euro, and the yen as reserve currencies that, when times are good, are historically used as what we call funding currencies for a carry trade. So when times are good, people will look to borrow and then short those currencies and put the money to work in higher yielding currencies, like, for instance, maybe Australia, but maybe even emerging markets. But when times get tough, they usually gravitate towards the reserve currencies. And amongst the reserve currencies, what they were going to be looking for is where they think they can get the highest potential return. And sometimes that return might just be zero, but it might be relatively better looking. And so I think what we're seeing is that investors are kind of telling you that on a relative basis between Europe and the U.S., there's more opportunities on a forward-looking basis in the U.S. than in Europe, which I don't think should be too much of a surprise to many people.
Well said, sir. Since you asked so nicely, Frank, we'll see if we can squeeze in a little FX right now. I just pulled up Euro USD while Rich was talking. Obviously, that's the leading currency pair. Putting up some numbers this week, nearly 40,000 contracts. That, dare I say it, almost lean hogs numbers for Euro USD. So they certainly merit some inclusion. By the way, that spread, 1.06. So that's what we're talking about. It's almost at parity, right? Wow, that's crazy. I can't remember. Obviously, it's been about 20 years since the last time we've seen anything like that. So of that, nearly 40,000 contracts, 33.7 going up in the June contract that has about 15 days to go. So let's look really quickly out here. Let's see. The vol, again, this is one of the reasons we don't talk FX too much. The vol is an 8.6, and it's off about a point this week. So it's actually a big vol decline for FX. Skew-wise, a little bit more action. The puts last week were 5.5% bid. This week, 10% bid. So puts getting bid up. Some folks are betting we're going to see a little bit of movement in this spread. The calls last week, 2% cheap. This week, 5.1% cheap. So puts getting bid up, calls coming in. It's like we're wagering that we're going to be moving ever closer to that parity level coming soon, even though we are pretty darn close to it right now. In terms of action, it was the at the money, or slightly out of the money calls, the 1.07 calls. I love the strikes out here as well. Actually, no, I take it back. It was the one even puts. These are July one even puts. Yes, that have about 50 days to go. These did about almost 5,000 contracts, 4,900 this week. And almost all of that, 4,200, was today. So a ton of paper going up today here. And these one even puts, that catapulted them to the number one spot, followed by the 1.07 calls doing 3,000 contracts here back in June. So yeah, a lot of paper out here. Rich, you're an old school FX guy. Does any of that sound surprising to you?
No, I mean, those parity puts sound pretty interesting, but I think every time we get to a round number like that, it's always going to attract a fair bit of interest. And so that doesn't sound surprising to me at all. And remember, like, we've got, we're worried about what the Fed's doing with rates here, and the ECB has really been kind of lagging behind. So really just on a relative central bank policy standpoint, there's another reason to be looking for the dollar over the euro. And so I think the price action makes a lot of sense to me. The behavioral linkage to want to look at those parity puts makes complete sense to me. And honestly, Mark, since I'm going to Europe next month for vacation, I'm really happy to see euro coming down here too.
I was going to say, you're loving this. This is 1-to-1.
Yep.
Yeah, God, it's been some time. Were you out there in FX when all that Swiss franc madness happened, or were you out of there by then?
I was out of there by then. My FX madness was the European exchange rate meltdown in 92, 93, then the tequila crisis in 94, the Asian currency meltdown in 97, 98, then we had Russia and Brazil meltdown in 99, and of course then we had the introduction of the euro.
I'll say you were there for the advent of the euro then. That's interesting because I was looking at FX coming out of college at that time. I knew I wanted to get into options trading. I wanted FX first, and I quickly realized even then everyone knew the euro was coming. So every desk was going from about 20 guys to 2. So I realized I should look at this maybe equity option market making instead.
Exactly.
Intriguing stuff out there. Speaking of intriguing stuff, before we get out of here, we have our great question of the week. You guys can still play along. It's got about a day or so left out here. We're asking you right now. People are looking for safe havens in these wild markets. We know a lot of you are in cash right now. So which non-equity asset class looks the most attractive to you right now? Give you 4 choices: fixed income, metals, energy, or crypto. Rich, I'm curious if you have a vote. We're only limited to 4, so we're missing a bunch. But if you have an asset class you prefer of these, maybe have at it. And then more importantly, what do you think our audience is voting for, sir?
I got to think that a lot of people are probably voting for fixed income now, given the extent of the rate hikes that are getting priced in if we go out 2 years, and the fact that the 10-year kind of hit that 320 area where it's topped out a lot in the last 10 years. It's starting to look that fixed income is probably getting to the point where it might be the first one to stabilize and turn. That would be my guess, but I don't know where. I don't know your audience well. I'm a first time on the network, so I'd be interested to know what they're thinking.
I'll give you a hint. They're not thinking fixed income. they're hardcore into energy right now. 47.1% Rich choosing. It's hard to blame them. It's getting all the headlines, right? It's getting all the oxygen in the room, seems like these days, is for energy. You can maybe argue it's already had its move, but hey, our audience is there for energy, 47.1%. Then a very rare tie for number 2 between metals and fixed income, both at 20.6%. Crypto, no love, bringing up the rear, only 11.8%. I guess maybe some of the price action of the past week maybe has dissuaded some of you. Either way, you got about a day, not even a day left to vote on this one. At Options is the place to go to make your voice heard. All right, everybody, that music means Rich has survived his first run through of the hot seat. How was it, Rich? Did you have fun?
I had a lot of fun. It was good. Didn't know what to expect, but you were nice to me, Mark. I appreciate that.
Always ease you in the first time. It gets crazier from here. So buckle in. If we have you back, it'll get nuts. But for the first one, it's usually nice and easy. A soft landing for you, Rich.
I appreciate that.
Well, Rich, if our listeners are intrigued, and judging by some of their questions they want to see more of your research or what you're working on, where should they go? What should they do?
Well, the easiest place to find me is on LinkedIn. I do a fair bit where I put out a chart of the day about the different markets and talk about what's going on LinkedIn. And then I also write a blog. It comes out every week, and it's called Stay Vigilant. It comes out via Substack. So if you're interested in either one of those, I would say go to the stayvigilant.substack.com and subscribe to that, or just connect with me on LinkedIn, and I'm happy to connect with everybody and share with you my thoughts on what I think is going on in the markets every day.
Substack. I like it. Hardcore. I'm guessing stayvigilant.com might have been pretty pricey. I think a few people might be looking for that one. But check it out. Stayvigilant.substack.com, or you can look them up on the old LinkedIn. It's Rich Excell, Excell, not spelled like the spreadsheet. An extra L in there. And of course, you guys know where to go to check out all these reports we're talking about here throughout the show and everything else including CVOL. We kind of just touched on it today, but it's an interesting one we don't get the chance to talk about a lot. All of that is available, cmegroup.com. If you want our reports, cmegroup.com/TWIFO, TWIFO is the place to go to learn more. Those are running 24/7, so you can check lean hogs at 2 a.m. on a Saturday. No one's going to judge. So head on over there to begin your journey. And of course, you know, it's crazy. We're coming up on recon time, listeners. So you know where to go to learn more about all things small caps. FTSERussell.com, FTSERussell.com is the place to go for the COVID Impact Center. All the info on recon. Is that the reason that June 8th is such a crazy day for mid-sized stocks? Might be. I want to talk to those folks about that and a whole bunch more. You can also give them a follow on the old Twitter machine at FTSE Russell, FTSE Russell, all one word, for a lot of info they tweet out throughout the week. That's going to do it for our broadcast day today. Remember, for all of our pro listeners, going to be messing with the schedule a little bit tomorrow. Going to be doing Volatility Views live from the Option Pit event. I haven't seen either of those guys in 2 years. So that'll be kind of fun. But I have no idea what to expect from a logistics perspective. So we're going to try to make sure the live stream is working. Again, a lot of that is dependent upon the connectivity situation at the venue, which will be the Drake downtown here. So fingers crossed we get at you to a live stream. That'll be earlier, 11 a.m. Central, not noon Central. And then the schedule for oddities is still fluid. I may come back to the studio and do that. We shall see. But so a little bit of a flummox. Blame the Option Pit guys. But a little bit of flux on the schedule for live tomorrow. Either way, you will definitely have it first and foremost in your pro podcast feed. So if you missed the live for whatever reason, it'll be there waiting for you in the pro podcast feed. And for everybody else, of course, you can check out Vol Views and this show on demand on the network if you want to get them sooner. TheOptionInsider.com/pro is the place to go. And then we'll see you back here next week. Another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.